McGraw-Hill Ascent Audio presents Finance Essentials for Managers, the tools you need to succeed as a non-financial professional, by Chris Haroun. Narrated by Jon Vertullo. Publisher's note: this audio edition references resources that can be downloaded at harouneducation.com/tools. Introduction. Welcome to Finance Essentials for Managers, the tools you need to succeed as a non-financial professional. In this book, I'll teach you how to enjoy finance, accounting, and investing. Together, we'll learn how to read financial statements and analyze companies just as you would a good book. Finance Essentials for Managers is not based on theory. Rather, it is based on my work experience, and it is based on companies I have started or where I have sat on the boards of companies. I have created many optional toolkit downloadable resources for this book. You can use these helpful frameworks when you analyze companies from scratch. Throughout this book, I'll suggest when you might download the optional online tools from my website, harouneducation.com/tools. The most important download we'll use in this book is an Excel spreadsheet I created based on my work experience. It's called 100-Step Investment Research Dashboard, and it's based on my experience working at Goldman Sachs and in the hedge fund, venture capital, and consulting industries. This spreadsheet contains 100 tabs for 100 investment research steps and links to about 100 YouTube videos explaining each tab/step. After completing the 100 steps in the spreadsheet, you'll be able to create a comprehensive one-page investment executive summary, a 100-page or more research report, and many automatically generated charts, data analysis, financial statement, and target prices, as well as a comprehensive dashboard. Please note, there are no macros in the spreadsheet. Only use the downloadable resources and content in this book as a guide, not for investment recommendations. Following this introduction is a comprehensive list of optional downloads I discuss in the book, including templates, exercises, resources, and much more. If you have any finance, accounting, or investing experience, please forget everything you know. I say this with love in my heart because I want to humbly teach you finance, accounting, and investing from scratch in a radically new, easy, and, as my son says, more funner way. Whether you are a seasoned professional or you don't know the difference between preferred stock and live stock, this book is for you. I apologize in advance for the awful dad humor that makes my 3 sons cringe. I hope you enjoy our journey into finance, accounting, and investing. Welcome to Finance Essentials for Managers, the tools you need to succeed as a non-financial professional. Let's begin. Chris Haroun. Finance Essentials Toolkit. 30+ optional downloads, templates, exercises, resources, and much more. To help maximize the knowledge you gain from this book, I have provided online resources that support your growth. The optional downloadable resources will help you forecast financial statements, value companies using different valuation methodologies, analyze companies, and create investment research reports of 1 to 100+ pages. I discuss each of these resources and internet links in the appropriate chapters. You can also find the list at harouneducation.com/tools. To view these spreadsheets, I recommend using Microsoft Excel on a computer, not on a tablet or mobile phone. In addition, as previously mentioned, I've created close to 100 YouTube videos that can be accessed from within the Excel spreadsheets for more in-depth details and explanations of finance, accounting, and investing topics. The most important download we will use in the book is an Excel spreadsheet called 100-Step Investment Research Dashboard. It contains 100 tabs for about 100 investment research steps and links to about 100 YouTube videos explaining each tab/step. Think of chapters 1 through 8 as a precursor, inputs, into our 100-step investment research process, outputs, that we will discuss in Chapter 9. Online resources for Part 1. The Essentials. Chapter 1. Introduction to Accounting and Finance. Jeff Bezos interview from 1999 on customer service. Revenue forecast spreadsheet download. Chapter 2. Introduction to the Income Statement. Oracle's Fiscal 2022 Fourth Quarter Financial Results. 8K. Income Statement Spreadsheet Example Download. Chapter 3. Introduction to the Balance Sheet. Oracle's Fiscal 2022 Annual Report. 10K. Balance Sheet Spreadsheet Download. Chapter 4. Introduction to the Cash Flow Statement. Cash Flow Statement Spreadsheet Example Download. Chapter 5. Introduction to Financial Ratios. Formulas Spreadsheet Example Download. Chapter 6. Introduction to Forecasting Financial Statements and Budgets. 7-step template of financial statements and modeling and valuation download. Chapter 7. Introduction to Valuing Companies. NPV Calculation Spreadsheet Download. Chapter 9. How to do Fundamental Investment Research. 100-Step Investment Research Dashboard Download. My VentureBeat.com article, When a Company Founder Resigns, Investors Should Head for the Exit Too. Elon Musk's significant purchase of Tesla shares on February 14, 2020. Form 4. Chapter 11. Introduction to Mutual Funds and Exchange-Traded Funds. ETF Database Website. Chapter 14. Introduction to Options and Derivatives. Options Analysis and Valuation Spreadsheets Download. Online resources for Part 2. The Essentials Applied. Chapter 15. Exercise on Creating an Income Statement. Income Statement Spreadsheet Exercise Download. Chapter 16. Exercise on Creating a Balance Sheet. Balance Sheet Spreadsheet Exercise Download. Chapter 17. Exercise on Creating a Cash Flow Statement. Cash Flow Statement Spreadsheet Exercise Download. Chapter 18. Exercise on Using Financial Ratios. Formula Spreadsheet Exercise Download. Chapter 19. Exercise on Forecasting Financial Statements. Financial Model Spreadsheet Exercise Download. Chapter 20. Exercise on Valuation Using Price to Earnings. Price to Earnings Spreadsheet Exercise Download. Chapter 21. Exercise on Valuation Using Price to Revenue. Price to Revenue Spreadsheet Exercise Download. Chapter 22. Exercise on Valuation Using Discounted Cash Flow. Discounted Cash Flow Spreadsheet Exercise Download. Time Value of Money Spreadsheet Exercise Download. Chapter 23. Exercise on Using Fundamental Investment Research. 100-Step Investment Research Spreadsheet Dashboard Download. 113-page Investment Research Report Exercise Download. 1-page Investment Write-up using Fundamentals, Valuation, and Technical Analysis Framework. 1-page Investment Write-up using Fundamentals and Valuation Analysis Framework. Online resources for Part 3, Beyond the Essentials. Chapter 24. Real-life case study on investment banking. Facebook's IPO. Facebook's IPO prospectus, also called an S-1 filing, download. Chapter 27. Real-life case study on investment management. Warren Buffett's portfolio. Berkshire Hathaway's 13G filing. Investment in Hewlett-Packard. Berkshire Hathaway's 13F filing. Chapter 28. Real-life case study on venture capital. Sequoia's investment in YouTube. Sequoia Capital's YouTube investment. Google SEC filing on the YouTube acquisition. YouTube's Series A pitch deck. Airbnb's pitch deck. Chapter 29. Next steps. Life-changing advice from Steve Jobs' video. Part 1. The Essentials. Chapter 1. Introduction to Accounting and Finance. Accounting is the language of business, and you have to be as comfortable with that as you are with your own native language to really evaluate businesses. Warren Buffett. What is the difference between accounting and finance? Accounting is based on what has already happened. It is more of a science, as it asks you to precisely record exactly what has occurred. Finance is more of an art, as you predict the future through financial projections. In order to predict the future, you must understand the past. Once you understand the basics of accounting, you can look for patterns in the accounting data that can help you understand the health of a company and predict what the future financial statements might look like. Finance is really subject to interpretation. It's based on assumptions, which will be covered in this book. Once we forecast the future financial statements, it is then possible to come up with the appropriate target price for an investment, or decide whether it makes sense to launch a new company or enter a new market. Revenue, the primary driver of financial statements. Manage the top line. Your strategy, your people, and your products, and the bottom line will follow. Steve Jobs. Don't be intimidated by accounting and finance. They initially come down to one simple rule. We must understand and forecast revenue, also called sales. Revenue is the top line of your income statement. Net income, also called profit, is the bottom line of your income statement. When an executive or investor says, "What is your top-line growth?" they are referring to your revenue growth. What is your bottom-line growth refers to your net income growth. Once we understand revenue, we can analyze what percentage of revenue our expenses are. These expenses might include the cost of the product/service we are selling, sales and marketing expenses, research and development expenses, general and administrative and other expenses. Revenue minus all expenses equals net income. Net income is an important factor in deciding whether to invest in a company, launch a new company, or enter a new market. Before discussing the income statement in Chapter 2, it's important to thoroughly understand sales. It is a primary driver of accounting and finance. There is a reason that great salespeople are also great CEOs and entrepreneurs. What causes revenue to rise and fall? In market research I did at Microsoft Corp in the early 1990s, I estimated that the Wall Street Journal took in about 75 cents per copy from subscribers, $1.25 at the newsstand, and a whopping $5 per copy from ads. The ad revenue let them run a far bigger newsroom than subscribers were paying for. Nathan Myhrvold, former Chief Technology Officer, Microsoft. All companies have at least one dominant revenue driver. Financial analysts that cover a specific business sector, e.g., the retail industry, spend a lot of time understanding the revenue drivers for companies in that sector. Investors are cautious, not to give a company they are analyzing too much credit for acquired growth, which is revenue growth as a result of making a large acquisition. Rather, they focus on organic revenue growth, which is revenue growth that is created internally. Focusing only on non-organic revenue growth might make it look as though revenue grew materially year over year, as reflected at the top of the income statement. However, this does not always reflect the company's financial health, as the company making the acquisition might have taken on a lot of debt, spent too much cash, or issued too many shares to fund the acquisition. Cash and debt are reflected on the balance sheet, covered in Chapter 3. For example, if McDonald's, Starbucks, or Lululemon acquired a large competitor, then this could result in significant year-over-year revenue growth. But the purchaser might have overpaid or diluted its shares with the acquisition, and profitability metrics could deteriorate. In Chapter 5, we cover assessing the health of a company using financial ratios. Retail sector revenue driver. Same-store sales. Different industries have different revenue drivers. In the retail sector, the primary revenue driver is same-store sales, SSS, which is a single store's year-over-year organic revenue growth. For decades after McDonald's initial public stock offering in 1965, the company saw material year-over-year organic revenue growth. Investors loved it, as the stock rose several thousand%. In the long run, though, same-store sales are very difficult to grow, given the law of large numbers, which means that it can be difficult for a very large company to continue growing revenue year after year. How did McDonald's get such great same-store sales growth? They used these strategies. Their employees cross-sold additional products to customers by asking, "Would you like a drink or fries with your order?" They started selling coffee. They introduced salads and other products. Some franchises started selling breakfast all day. Some franchises transitioned to being open all day, every day. They installed hard plastic seats to discourage customers from sitting too long. They installed automated, screen-based order systems to speed up the checkout process. They offered delivery in many markets. Technology, media, and telecommunications sector revenue drivers. In the technology, media, and telecommunications (TMT) sector, revenue drivers include average revenue per unit, ARPU, average selling price, the number of monthly subscriptions, and what percentage of subscribers end their subscriptions. The number of subscribers is particularly important for internet companies, such as Facebook, now called Meta. Venture capitalists focused on TMT companies often invest in early-stage companies that have minimal revenue. As a result, they tend to spend a lot of time analyzing the number of subscriptions. Using the logic that, if you build it, they will come, venture capitalists tend to think that companies with a lot of subscribers will be able to generate revenue from those subscriptions in the future. In fact, many venture capital companies don't really care about revenue initially, as they are laser-focused on subscription growth. When Evan Spiegel, co-founder of Snap Inc., was initially raising money from venture capital funds, some venture capital funds thought, "Why would I invest in a company that makes a product that deletes pictures I took? I don't get it." Once the same venture capital companies saw Snap's torrid subscription growth, they thought, "This is so groovy and dope at the same time because this is the best business model ever." In order to understand what drives revenue at internet companies, we don't look only at subscription growth. We also analyze monthly active users and daily average users. If both these numbers are quickly increasing, internet investors get excited. They think that revenue growth will be attractive if it isn't already. This begs the question of what is the rate of change of revenue for pre-IPO versus post-IPO companies? Generally speaking, venture capitalists love to invest in companies with accelerating revenue growth. Once growth is still positive but decelerating, then they often call their investment banking friends to take the company public or do an IPO. Almost all publicly traded companies have decelerating organic revenue growth because they are often much bigger than private companies. This is why investment banks make a lot of money, not only on IPOs, but also on mergers and acquisitions. Biotech sector revenue drivers. The primary revenue driver for a biotech company is either Food and Drug Administration, FDA, approval of a new drug, or the stage a new therapy has reached in clinical trials. Clinical trials determine how close a company is to applying for FDA approval. Financial services sector revenue drivers. The health of financial services companies can depend on changes in interest rates or housing starts, or how robust the financial markets are. Another revenue driver is government deregulation. Insurance companies, a subset of financial services, often find that adverse weather conditions lead to an acceleration of organic revenue growth because many consumers sign up for insurance after materially adverse weather conditions. Hotel sector revenue drivers. For hotel companies, such as Marriott, revenue per available room is a primary revenue driver. Instead of thinking that a hotel company must be thriving because it has opened many hotels, remember that new hotels can mean a debt burden. Instead, focus on year-over-year organic growth rate as measured by revenue per available room. For example, revenue per available room grows if the hotel begins selling Wi-Fi passes to guests or installs a mini-fridge in rooms. Industrial sector revenue drivers. Growth in national gross domestic product, GDP, drives growth for industrial companies such as Caterpillar and capital goods companies. Industrials tend to be very cyclical, meaning their revenue materially rises or falls in parallel with domestic and global gross domestic product. Industrial companies often lose a lot of money during recessions, which is why we tend to value many companies based not only on price-to-earnings multiples, but also based on price-to-revenue multiples. Commodity and other sectors' revenue drivers. Price and volume sold drive revenue for commodity companies. If in doubt on the driver of a given sector, I tend to love investing in companies when both prices and volume are increasing, while keeping an eye on inflation and increasing prices for labor and materials. Customer service is an under-recognized revenue driver. I believe that a company's organic revenue growth and its ultimate profitability prospects are much higher if the company is obsessed with customer service. As a result, I think small companies can take market share from big companies by offering superior customer service. In the long run, a company's organic revenue growth prospects are highly correlated with the quality of a company's customer service. I think that a company is only as good as its customer service. Take a moment to watch an interview with Jeff Bezos on this topic in the resources links for Chapter 1 on my website, harouneducation.com/tools. Before diving into how to read an income statement like a good book in Chapter 2, let's discuss how companies often forecast sales. Forecasting sales means forecasting revenue. Revenue is a primary driver of any company's success. Direct versus indirect revenue. I have never worked a day in my life without selling. If I believe in something, I sell it, and I sell it hard. Estee Lauder. As the name suggests, direct sales professionals sell directly to customers. However, companies that only sell directly to their customers are missing out on sales opportunities with people and in places where they don't have relationships. In this case, companies often look to leverage indirect sales channels. Every industry has their own indirect sales channels. For instance, in the industrial sector, companies often sell their products through W. Grainger and Fastenal. In the computer industry, companies frequently sell their products through Best Buy or other consumer electronics retailers. Direct sales are often more profitable than indirect sales, but companies can miss a lot of revenue by not having an indirect sales distribution strategy. Direct sales corporate structures. Companies typically have direct sales structures focused on geographic regions and/or industries, as well as what are called named accounts. These larger accounts may represent substantial percentages of a firm's income. The salesperson assigned to named accounts is responsible for particularly careful customer service. It's common for early-stage companies to have customers that account for more than 10% of revenue. For any company, however, such percentages are a material risk. Too much dependence on one customer is commensurate with owning a portfolio of only a handful of stocks. How companies often forecast revenue. The most reliable way to forecast the future is to try to understand the present. John Nesbitt, best-selling author of Megatrends. Companies often set quarterly quotas for their salespeople. Larger companies use sophisticated software from companies like Salesforce, Oracle, and SAP to manage the sales process. Many software companies also offer other products as part of an enterprise resource planning suite that can manage all data-driven aspects of their business, like customer relationship management, human resources, procurement, financial statement preparation, etc. Think of enterprise resource planning products as the equivalent of Microsoft Office for the whole corporation. Smaller companies often use spreadsheets to manage revenue quotas and assess the probability of meeting, missing, or beating their internal revenue expectations. Revenue quotas and probabilities. Companies often probability weigh their salespeople's chances of meeting their quotas based on how much they have beaten, met, or missed past quarterly quota expectations. For example, if a salesperson often misses a quota by 20%, and if the quota is $10,000 in sales this quarter, then the CFO or head of sales might forecast that the expected value of the sales generated by this sales rep is $10,000 times 80%, 100% minus 20%, or $8,000. I prepared a revenue forecast spreadsheet that you can download that explains how some CFOs and heads of sales structure their direct sales force when it comes to geographic, vertical, and named account strategies. The spreadsheet also calculates the expected value of sales by salesperson and can be downloaded from the resource links for Chapter 1 on my website, harouneducation.com/tools. The rest of this chapter is optional and based on this downloadable spreadsheet called Revenue Forecast Spreadsheet. The Revenue Forecast Spreadsheet explains how CFOs and heads of sales executives quantify and forecast sales. On the first tab, shown in cell B26, there are links to 9 exhibits in the spreadsheet for Chapter 1, which I'll discuss. Click on each of the 9 exhibits in cells B28 to B36 as I discuss each one. An investment banking and finance convention with Excel spreadsheets is to color a font in blue when it is a hard-coded cell, which means a cell without a formula. Feel free to change any of the cells with blue fonts in the spreadsheet.
Sample complete. Ready to continue?